To round out our panel discussions for today, we're going to turn to ways of creating value through sustainability strategies in private markets. To moderate this panel, I'm pleased to introduce Haben Berhe. He is the Senior Manager for Responsible Investment Ecosystems in the U.S. with the Principles for Responsible Investment. Welcome, Haben. Yeah.
Thank you, everyone. Great to be here. Yes, I'll have the panelists join me as well. Thank you for that introduction. My name is Haben Berhe. I am the Senior Responsible Investment Manager at PRI, which stands for Principles for Responsible Investment. For those of you who are not familiar with PRI, we are the world's leading proponent of responsible investment. We have about 5,300 signatories globally with assets around 128 trillion. Today, I'll speak a little bit about the value creation and private markets initiatives that we have launched in collaboration with our partners, CSB Stern, as well as Bain and others. To just set the scene, and then we'll delve into discussions with our esteemed panelists. Our initial program started, the phase one project, just looking at how to reframe the conversation around value creation and how it's driven by sustainability, but at the same time, sort of emphasizing the tangible financial outcomes, as well as making the business case for responsible investment. This is absolutely key in the current geopolitical context that we currently find ourselves in as well. Secondly, there will be sort of practical guidance that's going to come out towards the end of May and beginning of June, basically providing investors practical, insight-driven frameworks as well as a blueprint on how to do sustainability initiatives, as well as sort of tying it to financial outcomes. And the way we did it was very much in collaboration with sort of the overall IRI ecosystem, just leveraging the expertise and practices around this specific topic. One of the things that we did when we initiated this project was sort of issuing a survey as well as engaging signatories globally on sort of dialogue on a one-on-one basis, as well as in a group setting, to understand where the current state of affairs are around value creation. And based on this survey, we found that about 64% of investors definitely see the importance element of firm strategy and operations when it comes to value creation. But at the same time, sustainability linked value creation, they see as having a moderate to a significant financial impact. But at the same time, we also found a significant gap around implementation, as well as linking these initiatives to financial outcomes. Today, there's definitely a sense that most investors have implemented sustainability-linked value creation as a sort of common practice. But when you look at the numbers, about 60% of those investors actually do this for compliance reasons, as well as for reporting. And at the same time, we see there a gap in terms of how to measure this impact in a very effective way at portfolio level to assess exit multiples. We also undertook a look at sort of what the enablers are for the sustainability value creation initiatives, and we identified there are certain areas where are challenging for our investors. Including sort of defining and monitoring KPIs, as well as making sure sort of the deal team and ops team are sort of engaged. As we look forward, we've sort of completing the phase one of the project, and we will be issuing industry guidance. Eventually, we'll commence phase two, looking at publishing playbook as well as case studies. As well as finally sort of quantification of sort of the estimated financial impact of sustainability initiatives. If you have any questions, feel free to reach out to me after the session as well. For those of you, I'm sure here are very familiar with the NYU Stern's value creation tool as well for private equity, which is a sort of a two-part tool looking at sort of the upsides and downsides related to implementation of sustainability initiatives at portfolio level, and looking at basically across the investment life cycle. During the due diligence phase, the tool maps out portfolio's current performance as well as sort of generating a decision useful heat map. Secondly, during the 100-day holding period, upon acquisition, the tool helps investors in terms of assessing potential performance of material ESG issues related to these upside and downsides, and also sort of assigning sustainability aligned financial KPIs. And lastly, during exit, it provides a robust data on financial outcomes to assess sort of the upsides on sort of exit multiples. That's sort of an overview of the sustainability linked value creation project that we have been doing. And now I'm going to switch to just shifting towards our panelists here. Thank you all for joining us as well. And just briefly introduce yourself. We'll start with you, Amelia, and then we'll go down the line.
Or like a full intro.
However you want to do it. You're the
My name's Amelia All. I'm the Director of Impact at the Builders Fund.
And my name is Graham Thomas. I sit on the operating team within KKR, which is a private equity firm, and lead all of our efforts to expand broad-based ownership and employee engagement across our global portfolio.
Hi, my name's Jhanji. I'm part of a Swedish private equity fund called EQT Partners. We're around 200 billion of AUM, assets under management, and we're multi-asset. My work focuses on value creation, so supporting our private equity teams during the diligence phase, so pre-investment, and then also the hold period to drive that value creation up. I'm also an adjunct and will be teaching at NYU Stern this summer. So should you be interested, come along.
Thank you all three. This question goes to all of you. Perhaps we can start with you, Amelia. But just please tell us a little bit about your firm's approach to sustainability, both on a firm governance level as well as at the portfolio level.
Sure. So Builders Fund, we are a growth stage private equity impact investing fund. We've been around for about 10 years now and are well through our second fund. We're looking for companies that have an integral environmental and or social benefit to their business. So as we scale and help grow these companies, we look for collinear growth with the financials and the impact of the company. So sustainability and sustainable performance is very important to us, to the work that we do. We want to build companies that have purpose that also last. So we're not looking for like hockey stick growth. We're looking for sustained, impactful growth over time. And for Builders Fund, in terms of our governance, we're UNPRI signatories. We are a certified B Corp and have been for about 10 years, which focuses partially on good governance. We've got an independent investment committee, and so we're taking measures to ensure good sustainable practices at the fund level. Have been recognized for those actions by Blue Mark. Most recently, we received a gold rating in our governance. So we think sustainability is important to like have these markers of rigor that you can demonstrate to the outside world to kind of move the industry forward. So that's at the fund level. At the portfolio level, we're deeply engaged in sustainability with each of our investments. We work with our portfolio companies to go through the B Corp certification process, which for us really represents a holistic look at not just ESG risk mitigation, but also what is the impact business model of a company? How can you verify it? How can you benchmark it against your peers? How can you understand areas for improvement? And so that's a big part of our value creation strategy from an impact perspective. And then again, in terms of aligning to like global norms. We build out an impact strategy for each of our investments from the diligence phase that maps down to impact KPIs. So we map those to the UN SDGs and to the GIN's IRIS Plus metrics. But really what we're looking at is like what's core to the business model that we can measure and track over time that holds the business accountable, but also helps to drive strategy, drive operational improvement and efficiencies. And so we've kind of taken from these existing resources to pull into to develop our own kind of custom sustainability and impact strategy for the fund.
Thanks for that, Graham.
Yeah. So at KKR, we frame everything we do around sustainability under value creation or value protection. On the value creation front, that could mean actually investing behind sustainability-related macro themes. So we actually have a climate fund and an impact fund. And then within individual portfolio companies, we'll look for opportunities to ride on those macro themes. And then on a micro level within the portfolio company, we're looking at how to mitigate risk and how to capture opportunity. And that's going to look different in every company. We do a materiality approach to looking at what we're going to focus on in each company. So we may look at physical climate risk in our real estate assets as we're doing diligence. We may spend more time on consumer lending practices for a financial services business, and we may do a deep dive on health and safety for an infrastructure or an industrials company. Within KKR, then, we have a few areas where we've really doubled down on creating centers of excellence in global resources. So that would be climate, cyber, human capital, and governance. So the human capital pillar is where I spend most of my time. And again, the degree to which we get involved with any company is going to be based on the materiality of that company. Now, some of those, like human capital or cyber, we think are going to be critical to every company to some extent. Within the firm, we have multiple governance levels, right? This is baked into what the board is caring about and their committees. At the partner level, and then within the portfolio company, we'll set up structures to monitor progress against any of these initiatives that we've deemed material and baked into the investment process.
Very cool. Not much to add there. I think we're very similar with the multi-asset strategies. But maybe I can give you guys a bit of a framework for how we think about it in terms of kind of a framework and then what we do inside the portfolio. So in terms of a framework, we think about it as must-haves versus nice-to-haves. And our first two must-haves are downside protection. So it's definitely having a look at how the regulation is moving in all the various markets, making sure that all of our investments are future-proofed from a place of, are you meeting regulation? Are you making sure that, you've got the right data, that we're being responsible investors? And the second must-have is all of the kind of commitments we've made as a responsible investor. That includes PRI, but it also includes things like science-based targets and making sure that when we're investing in these large, ticket items, that we are doing our best to try and support those companies in realizing things like decarbonization. As we move towards the nice to have, so where do we particularly pick out our portfolio to have an outsized impact? We think about it in terms of value creation. And it's very similar to what Amelia said in terms of upside, right? How are we driving revenue? What's on our revenue statement? How can we think about customers, the management team, the product, the way that we package it? Or its efficiencies. So thinking about your balance sheet, what are the liabilities? Are we, again, similar wording, value protecting and making sure that we're being very eyes wide open about any sort of risk? And if our portfolio companies can go through 1, 2, and 3, then we might have a look at impact. And we set a high bar for that, but then we can start to think about what good are we doing in the ecosystem around us? How is this company moving an entire market? So that's kind of the way we think about it from an investor perspective. But then inside the portfolio, we really believe about empowering our management teams to be future-proofed and setting these companies up beyond our own ownership period. So we definitely anchor very heavily on governance. We have a sustainability board champion on the board whose sole job it is, on top of obviously bringing very, very useful insights to the board, is to make sure that they challenge the board on sustainability topics, right? And we are sparring partners in that debate, really challenging them to say, hey, we've seen this. Have you seen this? Are you bringing it up? what is the board's response? But then equally, we're involved because we're upfront in the diligence process. We're able to take those insights into the value creation plan, so the full potential plan, the 100-day plan, whatever you might call it. But setting a management team up with, we've had a look at your investment, we've had a look at your company, we've also had a look at your products and the markets that you play in. These are the couple of things that we really think that you should be thinking about in order to outsize return, but also take on your market. And sometimes these are linked. These are completely hand in hand with the way the company's thinking. And sometimes the companies are rather small, or they're rather big, or that they're put together, whichever magic puzzle you might build of them, and they're slightly newer. So the agenda comes about of how do you get the right sponsorship? Do you hire a head of sustainability? Do you think about this from the CFO agenda? Is this something that sits in legal? How do we really put this in place so the company can really start to think about this quite pragmatically? And so we'll do workshops, we'll do the upskilling, but really this is, a game of how do we empower and how do we actually bake in that knowledge from day one so we can see it come to fruition in the next 4 or 5 years.
Fantastic overview from three of you. Really appreciate that. Just drilling down a little bit now, which types of sustainability strategies and practice have you seen drive financial value? And what has worked and what has not worked in your specific firms? You want to go, Amelia?
So we really consider purpose and sustainability as key drivers of value and as sources of outperformance for companies in a risky, volatile, and changing market like ours. And so for us, it really starts from the top of the diligence process to understand what are the potential drivers of value that Builders Fund as an impact-focused investor can support. And I should mention, we get our name from this idea of this matchmaking process that we do with our LPs and our portfolio companies. So we're very hands-on, very partnership and collaborative investors. So when we make an investment, we take a board seat, we matchmake our LPs who have many of them are former operators. They have direct industry expertise in the industries into which we're investing, which allows us to broaden our scope of industries in which we invest, which is great. So we do that matchmaking process. We take a board seat, and we go through for PE quite lengthy and hands-on diligence process to really understand the current and potential impact and growth levers for a company. And so when we're building out our 100-day plan, we also build out what we call an operating blueprint, which is quite detailed and gets into the nitty-gritty of how we're going to evolve and grow the company in a collaborative way. So when we talk about value creation for Builders Fund, it's definitely co-creation. And this is the question that we've been asking ourselves a lot, is like, how do we actually measure and understand this value? So a lot of it, I would say, has been learning by doing, as we do as entrepreneurs and former entrepreneurs and investors. You have to kind of test out these assumptions. And in our portfolio, a couple of recent examples I'll share of projects that we've taken on. One is with Fund 1 and 2 portfolio company, Traditional Medicinals. It's one of the top selling herbal tea brands in North America. Maybe you all know Throat Coat and Smooth Move. Those are crowd pleasers. Sometimes you wish you didn't need one of those, but sometimes you do. And that's a deeply purpose-driven and values-based company. It's been around for 50 years, does deep engagement in their farming communities and supply chains to promote right livelihoods, good jobs in their botanical supply chain, and is a pioneer in fair trade and organic sourcing practices. And those things have all been baked into the company since its inception. A couple years ago, we led the board and the executive leadership team through a purpose, values, and vision kind of restructuring and refocus exercise. This is something that the Builders Fund team has done on occasion with multiple of our portfolio companies. And it's not just a marketing exercise to come away with flashy language to like update on the website, even for a brand like Traditional Medicinals that's deeply rooted in sustainable practices. Going through that process of kind of realigning the entire leadership team of the why, and also getting feedback from different stakeholders helped to solidify new messaging forms, new areas of productization that they wanted to move into, and also really reinforced a growth strategy for the company of expanding into some new areas. And so we saw that, I suppose, as a success, as a successful example. But the outcomes and the follow through from that are still kind of forthcoming. And then just one other quick example I'll share is with a Fund 2 company we invested in, Posigen. It's a residential solar company that focuses on low to moderate income households, and so has a climate benefit of expanding access to renewable energy. Those customers often otherwise would not have access to solar, and then also has an economic and social benefit of reducing utilities for low income customers. So a really nice kind of intersecting impact business model. And we worked with Posigen to become to change their governing documents to become a benefit corporation and to go through the B Corp certification process. They became certified 2 years ago and kind of joined the ranks of some other solar companies who are certified in the space. And B Corp certification for the company, I think, has a lot of value creation drivers. One, in terms of engaging and inspiring trust with their customer base. The B Corp certification has a lot of growing consumer awareness, and there's a perception of a high amount of rigor associated with it. So customers tend to trust the brand. There's also benefits around employee recruitment and retention. Employee satisfaction levels tend to be higher, and so you're really reducing some operational inefficiencies and creating value there from the customer perspective as well as employee perspective, and then reducing risk from a governance perspective, since becoming B Corp certified requires changing your governance. It ensures your mission lock over the long term. So it really provides kind of some holistic levers for us to pull. And again, these are, the company got certified maybe a year and a half ago. And so far they've reported initial success, but we're kind of monitoring to see like what, how is the value created from that process.
Thank you for that perfect example there, for sort of detailed look at what you've done around your portfolio companies. Graham, over to you. Just strategies that have worked and that have not worked, and then we'll hold off on sort of a case examples. I think you're going to talk about that later, but around the strategies that have worked and what have not worked.
Yeah, I mean, I would say every strategy has examples of where it's worked and where it hasn't. I think it all comes down to execution at the end of the day. So I'll give you an example with our broad-based ownership programs. Across the 40 or so active ones we have, where we have year-on-year data, 80% of them have seen the quit rate decline. So that's meaningful, but 20% haven't. And a lot of it comes down to execution and leadership at the top. And how things take part. And we'd say similar things across our efforts in climate and cyber and some of these other areas.
Angie, similar?
Yeah, similar. I can kind of add color to it when we get to the case studies. But if I think about value creation and the reps that we've done in terms of the portfolio, there's 3 real ways that we end up seeing it done. So first is with an intervention. So you get some data, maybe their kind of turnover rate, and you're putting it against the ENPS score, and you're having a look at what's going on with this company and what does that mean. I think there's medium term kind of value creation where you can probably do, a marginal abatement cost curve for decarbonization and use it as a lever for, hey, you've got your Gen 5, 6, 7 products coming. So how do we think about those now that we know that procurement is impacted by this type of resiliency problem, or et cetera, et cetera. And then I think there's a long-term view that's like, hey, you have factories and those factories don't have energy security. And so are we thinking about geothermal? And there's a huge CapEx and OpEx question that actually probably goes to a question that's longer than our 5 or 6 year hold period. And so if I think about those 3 archetypes of value creation, The first obviously is the big bet, right? Like that's the one that everyone's going to get super excited about. That saves the deal team $2 million a year and everybody's super excited. The only problem with that is that we as private equity funds cause a lot of attrition. And you don't really understand that until you've gone through a couple of those reps and gone, oh, we saw that we saved some money and the NPS score went up momentarily and then it went down. Why did it go down? Oh, because we emanate an entire new business to it and therefore completely change the fabric of that culture. So there's things in there where because you're trying to solve a problem in the real time, and in real time in private markets, you're actually playing with an investment, right? You're trying to make it stronger for the future, but you actually don't know if that strategy works. And that's usually an example of, when we're on our second CEO, no one thought that the first CEO wasn't going to make it. The whole plan was that CEO number one was the dude. He was going to be impactful and he was going to enjoy the the tailwinds that was going to provide. So that is the one that's the trickiest. I'll say the most volatile. I think the one that's hardest to get the investment for is option number 3, geothermal investments to your factories, heavy CapEx and OpEx. Who's absorbing that on their balance sheet? Who wants to then bet on something that's definitely not going to hit our returns in that short time? But that's where I agree with you that, it's the language from the top. It's the resiliency of that business model. It's that management team taking a bet around things that they find volatile today. And that middle one is usually the one that is the most effective, right? You're doing some strategic work. You're having a look at the inputs and outputs. You're taking that kind of medium-term view. And if you can really find something compelling, like climate risk resiliency or like a product or like a procurement saving, people are going to be a lot more receptive to it and a lot more willing to kind of lean in.
Fantastic. Graham, I'll come back to you. So KKR has developed an approach to driving sustainability-linked financial value by focusing on the human proposition, employee stock ownership plans, and emphatic CEOs. Can you walk us through your learnings and give us a case example around that?
Yeah, sure. So we've been experimenting with employee ownership for about 10 years. In 2021, we really started to go all in as a firm across our America's private equity business. And then in 2024, we went global and we started going across all asset classes. So currently, for the last 15 months or so, we're averaging the rollout of a new broad-based ownership program every 15 days or so. So when we purchase a company, we will take a pot of the equity value that has yet to be created, and we'll set it aside for everyone in the company, including the hourly workers who's not already part of an existing management equity program. And we target very meaningful payouts. So in most cases, if we achieve a base case outcome, someone who's been there the whole time can get about a year's worth of salary. So we've learned a few things, right? One is that you really need a CEO who cares and is willing to do the work and to try new things, to not just put an equity program in place, but actually transform the culture of the organization, which is where this becomes powerful. And the culture is driven by the day-to-day lived experience of the employees. The second thing we found to be really powerful is approaching culture and turnover and some of these people metrics with the same operational toolkit we would any other ops issue. So I'll give you an example as we dive into CNG there, but really it's just taking that same level of rigor and a focus on data to people metrics, and then implementing a holistic plan. So we talk about sharing wealth as the first part of what we're trying to do. And we define wealth holistically. We have the equity piece. We also put in place near-term financial wellness incentives, employee assistance funds, and financial coaching for people. We focus on a company mission and purpose that inspires people and other well-being initiatives. Then we talk about sharing knowledge, helping every person understand, what does this whole business do? How does it make money? How does it generate cash? How do I have line of sight to how I impact that in my role as an employee? And then sharing responsibility. So constant two-way communication through engagement surveys, listening processes, and then continuous improvement and innovation efforts. So Charter Next Generation is a great example of this. They have a very empathic CEO who actually sought us out. She'd had 3 successful private equity exits and then came to KKR and said, hey, buy me next. I've made my money. I want to do this employee ownership thing. And so we partnered with them in early 2021. We did the first ever engagement survey with them, and she found out her organization was at the 32nd percentile. And she actually cried on the debrief with the Gallup team when she found out and saw some of the quotes about the experience her employees had. It was very eye-opening. And one of the first things she did was start a podcast called Our People, Our Purpose, where she just took random people from the organization, sat down with them for 45 minutes and unpacked, who are you? What makes you tick? How did you get to where you are today? And I was meeting with her monthly during that period, and I saw the transformation in the way she started to think about her people and think about her business as she just started to spend more time around the organization. That led to a reevaluation of what the company stood for. So they did a big rebranding to the company mission is to enhance lives. They talk about enhancing the lives of their own employees, enhancing the lives of their customers, enhancing the lives of the communities that they work in, and enhancing the planet through their sustainability work. On the data front, in the first year, we made strides in engagement, but we didn't actually make any improvement in turnover until we invested in really getting visibility and quality data on turnover. And then once we did that, we saw, hey, we have more turnover in the night shift and what's going on there. And we could put in place targeted interventions. And we have a lot of turnover for new people who just joined. So let's rethink the onboarding and the training experience and the hiring experience and how we're vetting people. We had certain plants where it was really concentrated. We had a couple plants that were at 40 to 50% turnover, and the organization as a whole is at 35% turnover. So these plants are turning over their whole workforce every 2 years. And we made leadership changes, and last year those plants landed at less than 10% turnover. As an organization, in 3 years, they've gone from 32nd percentile in engagement to 86th percentile. Turnover has gone from over 35% to less than 15%. And then we've been able to harness all of that energy towards value creation because their owners in the business was skin in the game. So last year we launched the Moonshot Challenge at Charter Next Generation, which was a challenge from the CEO to find $100 million in incremental margin on an EBITDA base of $300 million. The goal was to do it in 3 years, and in the first 6 months, they've identified $40 million in run rate savings opportunities. And a lot of these are just employees thinking differently in their everyday roles. So they shared an example a couple months ago of a guy who was looking at an invoice sheet of parts, and he realized they were paying $150 for some pretty basic components on something. And these were often out of stock and they were tricky. This guy was a 3D printing enthusiast, so he went home, he recreated the parts himself, they tested them, there was no quality impact. They bought him a 3D printer for the plant, and he started making these things for 46 cents that they were paying $150 for, and it's going to save him about $250,000 a year. And so that's kind of the holy grail of what we're looking for is how do you get every employee to look at an invoice sheet and feel personally offended that they're being overcharged because they feel like that's my money as an owner of the business. And they've done a fantastic job with educating the workforce, storytelling around these things. They have a whole ownership moments video campaign where they tell these stories of employee ideas that perpetuates this culture throughout the organization. So that's just one example of where this has really been clicking and going well. And then some of what we've learned about what works and what doesn't.
Fantastic, and congrats on that. This is a perfect example on how practically sustainability-linked value creation can work at a portfolio company level. Angie, get the last word on specific example case studies on your portfolio companies as well.
Yeah, it's hard to follow that example of 3D printing. I'm going to be thinking about that. So I can give maybe 2 examples quite similar in vein, and maybe a third in the kind of value creation. I'll leave the short-term fun. I'll talk about the medium one where we have the kind of biggest bang for our buck. So, and then similar to what Graham said, we follow those macro trends. So thinking about healthcare sector, thinking about pharmacos. If you know inhalers, right, propellants are a big problem. For pharmacos, 50% of their scope 3 are propellants. This particular propellant called HFC is 1,400 times the badness of CO2. And so we see this whole market kind of void of anything that's happening in terms of innovation. And so our deal team are looking at one of our healthcare companies and they're kind of splitting up certain bits, chipping, chopping and changing it. And we start to see a synergy. We start to see a gap in the market in terms of, hey, you know, we really could think about inhalers. We could think about propellants. And we have this part of a business that's completely focused on it. What we ended up doing is aligning with the commercial diligence and thinking about what we could do in terms of first market mover advantage. And that came from the customer surveys from the pharmacos, who equally were quite perplexed about how they're going to move their agenda in terms of scope 3, but also start to change in terms of plastics and then propellants. And so what we found was we could actually take a business, think about it in terms of commercial output, look at its products, have a look at some green products, which, by the way, were 90% less CO2 intensive than the products that they were actually selling, and start to rethink about the way that they did business in two parts. So decarbonization on the ops side, which is how do we get the propellant from where we're buying it into an inhaler? How do we stop propellant leakage, which is a problem for them as a company? So this impacts my bottom line. Versus how do we now service a market that we can see being made, but we want to be the first mover. And so these green propellants, if we switch to them and we start to really think about the supply demand effect for the pharmacos, we can really see some level of advantage. So that's one where it was almost hand in hand, the commercial and sustainability case. And so that's where we almost synergize in terms of value creation, right? Is it my showcase story? Yes, today it is. But it actually will be the deal team's story, right? This will be an investment that will have completely flipped that business, but also position it in such a way that, you know, the large pharmacos of the world will finally have a product that they can actually put into a suite which is net zero or closer to. The second example is another healthcare kind of device company that was a little bit exposed to PFAS. And so we're thinking about those, the devices and, you know, having a look at regulation, having a look at those market trends, having a look at how much, you know, legal structures are charging for the spillage of PFAS. And you start to talk about it in terms of, hey, this is a liability. Are we really thinking about this? What does this really mean for our balance sheet? What does this mean for our resilience as a business? Supply, demand, and all the right conversations. And you start to move towards, is there an alternative? And it's not just, can we just buy something different because we manufacture them? Actually, can we think about the next gen of this, where there's something different used in the innovation arm? And so it went from a commercial question to an R&D question, and it's now fully baked into their R&D arm. Will that product be available during our hold period? I don't know. But will it definitely now be a core part of the story that the employees are holding on to and that the business is using to think about how they position in the future? Absolutely. And then you see the market penetration, the positioning, the way that you think about that product and that entire business start to move towards sustainability without having to use the word sustainability, right? It's a market dependent thing. And then that long-term piece is we've got an animal healthcare company who kind of thinks through products, and they have factories. And we were doing all this work around renewables and, you know, thinking through these kind of certificates and what it means for their decarbonization strategy. And the great thing about them was that they did decarbonization before they came to us. So they had the CFO that just absolutely knew what scope 1, 2, and 3 was, which is magic. Absolute magic. And he's talking to me and we're talking about renewable energy, and he's just like, Andrew, these factories, they just don't have energy resiliency. So what are we going to do? And without me saying much, you just had someone pop up their hand. They went, oh yeah, and I know exactly what. This area of the world, geothermal, we're going to put in some capex. And you just saw some people, how much? And actually, after they did that, they were like, it's not so bad. For how long? Like forever. Like that is energy resiliency in your factories for the rest of that lifetime of that factory, which is then going to impact your product. And by the way, all the benefits of your product of being slightly more decarbonized, being able to be more resilient, making, you know, I don't know, I should have told them about the 3D printers, but making sure that your product is available when it's needed. I think that was the kind of, you know, interesting having those conversations that will hit a lot longer than they'll be with us, but in a way that is actually quite inspiring to see when you flip the switch around decarbonization, you really do start taking a long-term view.
Amazing highlights. Thank you so much. We have 5 minutes and open it up for Q&A from the audience if you have any.
Hi, everyone. So I'm curious, Graham, to hear from you about the structure of the broad-based employee ownership. And you mentioned it's tied to sort of future profits of the company. So I'm just curious the mechanics of that a little bit, if you wouldn't mind sharing.
Yeah, we're relatively loose on the exact mechanics and more adhere to some principles. So typically, it's an unallocated pool of equity, which makes it very easy to administer. That could be a pool of options, profits, interest units, phantom equity, doesn't matter. But basically, it's a straight percentage of value created over the course of the investment. A couple important things. It starts participating at 1x. We don't want to put a bunch of hurdle rates where we tell them they're owners, we have some kind of return, and then we're like, well, sorry, but it wasn't a big enough return. So anything above 1x, they're going to share in. We don't let them put any of their own money in, so they can't lose anything. It doesn't come at the cost of existing wages or benefits. So we tell them there's no guarantee what this will be. It's a percentage of the upside, but there's no downside for you. We're not taking anything away. It's all opportunity. And then we make sure it's meaningful. And so I mentioned the sizing. We have standards around how big it is, but we're very cognizant of not giving a token amount of equity that at the end of 5 years doesn't feel like a good reward for the work that they put in.
Hello. I was curious about the perspective from your LP side. What is their current demand and how has it been evolving? What type of information they want related to sustainability and reporting? Could you discuss a little bit about that? That would be really great. Thanks.
Is this directed to a specific person or any?
I mean, they are all private equity investors, so I guess their own investor, if any of them could discuss about that, that would be great.
Any takers?
Sure, I'll answer quickly. So yeah, Builders Fund as an impact fund, our LPs are all bought into the impact investing premise. They expect and now have come to look forward to our quarterly impact reporting that is quite intensive and quite in-depth. I recognize, because I've heard feedback from them like this, not necessarily the industry norm, but because we're looking for collinearity of our financial and impact performance, we're reporting our financial and impact performance side by side, quarter by quarter, because we're trying to track the evolution of those things together. So I would say it's kind of we definitely get encouragement and questions from our LPs. And sometimes they have introduced us to like new working groups or new systems that we might participate in. But we also share lots of sustainability related information with them and generally get very, very positive feedback from it. But again, we're kind of filtering for an impact focused audience.
Yeah, and I just say that it is becoming increasingly polarized. Where you'll have an LP one day that demands something, and the LP the next day that says, "If you do that, we're going to divest from the fund." And so, I think being able to tie everything we're doing back to value creation or value protection, we can argue why whatever you believe from a moral perspective, like there's a good reason for us to be doing this. And that's part of the reason that we take that materiality approach and don't take a blanket approach across the portfolio.
I think the only thing I can add is, I guess, from a market perspective, you'll often find the fund managers who are public will do quarterly reporting and likely have quite large LPs where it's pretty standardized what they're asking for. They've been asking for that for a long time. And then it also associates with the SFDR Article 8, Article 9 association. So it almost becomes a sort of compliance type kind of, you're replicating it, you're doing what you need to do all the time. I think where I see the difference is some of the smaller GPs who are maybe not public. They are a little bit more, and it depends. Like if you've got large companies like I do, it's, they typically are quite used to providing data. But if you're more in the middle market where a management team's just getting their head around what sustainability means, you're going to be in a little bit more of a tough spot. And then your LP should be rather understanding, in my opinion, to try and understand that you're going on a journey. So a little bit of maturity and the control, the public facing versus private, and the size of your ticket size probably matters as well.
Afraid we have to end it there. Thank you so much, Emily Stern, and please join me in thanking our panelists for their time and expertise.